0% growth at one of the biggest consumer companies on Earth, and a 43% surge in the cloud. Both landed in the very same week. Welcome to the most revealing earnings stretch of 2026. Between July 27th and August 2nd, giants like Microsoft, Apple, Visa, and AbbVie all opened their books on the S&P 500. And together, those reports tell one story. The market now pays for receipts, not promises. I must show real cash flow. The consumer is splitting in two, and a supply chain squeeze is brewing that analysts are calling once in a century. Let's break it all down. First up, big tech and the AI money test. Here's the shift you need to understand. For 2 years, Wall Street bought the AI story. Now it wants the AI invoice. Microsoft passed with flying colors. Azure revenue jumped 43% year over year. Amazon's AWS grew 37%. Those are measurable, countable dollars, and investors rewarded them. But look at Meta and Apple. Both posted strong core businesses, and both got hit anyway. Why? Neither has a clean external AI revenue line that investors can measure. The verdict is blunt. Show me the money, not the demo. But here's the catch, and this one reaches your wallet. Tim Cook warned that advanced chip nodes and advanced packaging are facing severe supply imbalances. Think of it like a gold rush, where every pick and shovel in the hardware store is suddenly sold out. Memory chips and packaging costs are soaring. That squeezes hardware margins and pushes up prices on end products, and Apple's Mac Studio is already feeling it. So the AI boom isn't just a stock market story. It's quietly making your next computer more expensive. Now, the flip side, where AI goes next. Meta is betting that smart glasses, not bulky headsets, become the most important gateway for AI at the edge. And Qualcomm expects its automotive and Internet of Things chip revenue to grow more than 60% by fiscal 2027. Translation? AI is breaking out of your phone and moving into your glasses, your car, and everything around you. Let's shift gears to payments. Visa and MasterCard are still riding a powerful wave as global travel and business-to-business spending keep cross-border fees flowing. Now, look at this data point. MasterCard reported strong growth in online card-not-present transactions. That calms fears that high interest rates are killing consumption. The shopper hasn't disappeared, they've just moved online. But the card giants aren't standing still. They're racing into value-added services, anti-fraud tools, AI microtransaction clearing, and even stablecoin settlement. The strategy is simple. Stay essential before decentralized payment protocols eat their lunch. Meanwhile, Robinhood just showed us where retail traders are heading. They're drifting away from crypto and piling into riskier turf. Options and event prediction contracts, including election-related bets. That's a whole new species of trading. And it's growing fast. Now to pharma, where the story is survival of the fastest innovator. AbbVie and AstraZeneca are both staring down patent cliffs on blockbuster drugs like Humira and Farxiga. When a patent expires, it's like the moat around a castle suddenly draining. Generics flood in. But both companies are refilling the moat fast with next-generation autoimmune and cancer pipelines. And AbbVie went a step further, dropping $10.9 billion to acquire AbbVie. That's the new playbook. Use massive cash flow to buy your way past patent risk. And here's the offensive move. AstraZeneca just launched Phase 3 trials for an oral GLP-1 weight loss pill. Read that again. A pill, not an injection. That puts traditional pharma on a collision course with Eli Lilly and Novo Nordisk in the most profitable drug market on the planet. Let's zoom out to the consumer, because this is where it gets fascinating. Spending is splitting into a dumbbell. On one end, luxury is thriving. LVMH's jewelry division posted 11% organic growth. On the other end, affordable everyday indulgences still hold hard pricing power. Zero-sugar Coke shipment volumes jumped 16%. The very top and the very bottom are both winning. But the middle? The middle is breaking. Procter & Gamble's normalized organic sales growth fell to 0 this quarter. 0. That's the market telling us the middle-class shopper has hit their limit on brand premiums. They're trading down to cheaper private label alternatives, and they are not coming back quickly. And it gets tougher. Ocean freight costs are back near highs, and wages are sticky. So the classic consumer staples giants are getting squeezed from both sides. High costs, weak demand. For companies built on selling soap and detergent, this is a genuine financial grind. One more story worth your time. Coursera is reinventing itself as an AI-native education platform. Through its investment in LearnVector, it's turning static course catalogs into interactive learning with intelligent agents baked in. And it's working. Its enterprise segment doubled, powered by corporate hunger for AI training. So here's the big picture. This earnings week drew a line in the sand. Markets now reward measurable cash flow over AI hype. Consumers are splitting into haves and have-nots, and the AI boom is creating real-world bottlenecks that hit everything from chip supply to your next laptop. So the question is, which side of that divide are your investments on? Drop your take in the comments. Are you buying the monetizers or betting on the bottlenecks? And if this breakdown helped, hit subscribe, because next week's numbers are already on deck.